So this video was actually inspired by this comment from Lazy Investor. So he left a comment on my last portfolio update video with the title, All in Alibaba, lost my underwear, question mark. So in that video, I've reviewed my exact positions, my cost basis for my positions, and how I've fared thus far over the last 2 years. So not going to lie, it's not a very pretty picture. But I still want to honor transparency, which is a rare trait amongst finfluencers. So if you haven't checked that video out, feel free to do so. I'm basically bare naked in that video. Now, let's get back to the main topic of whether I gambled my money away in Chinese stocks. So I think just to get semantics out of the way, it would be helpful at least to first define how I personally look at investing versus gambling. So to me, both are risk-taking events. Specifically, both have risks of permanently losing capital in hopes of making a quote-unquote profit. So the slight difference is probably the expected return in the long run. So if you were to go into any casino and to gamble your life savings away, in the long run, theoretically, the odds are not in your favor. That's why they say there's a house edge. So you know what is in your favor? Of course, it's smashing the like button. That's 100% ROI on your investment. So don't miss that out. New year, new sign-up rewards. So Webull's new welcome deal for the start of 2023 has never been better. So you can get up to $150 trading vouchers if you fund and trade your Webull account today. So all you have to do is to sign up for a new account with the link below and deposit at least 2,000 Singapore dollars and execute one buy trade on a stock or ETF and one mutual fund, coupled with buying one option, and you will get to enjoy a whopping 10.5% return on initial capital. So for those of you who are still considering sitting on the sidelines, I don't know what's holding you back. So when the markets are slowly selling down and S&P 500 just keep grinding downwards, I think it's a good opportunity to start dollar cost averaging into the markets. And you can even get an additional $150 to do so. So Webull prides itself on zero commission trading, and you can stop paying all the redundant commissions and use it to buy more shares. So recently, they've also allowed for a zero fee subscription and redemption of mutual funds on their platform. So don't let this opportunity slip away so easily. Link to sign up is in the description box down below. Thank you Webull for sponsoring this video. So for investing, however, it's a black box. So truth be told, you don't know what your long run expected return will be. It's dependent on a multitude of factors. So if you to compare between the two choices of 100% losing versus a question mark, I'll pick the question mark anytime, any day. So if you really have a core understanding of how the stock market essentially works, it actually operates on a relatively simple foundation. Essentially, you just have a huge pool of demand and supply aggregated on an exchange. At any one point in time, the market is essentially just reflecting the sentiments of a particular stock with its price action based on demand and supply. So in order for you to earn money in the long run, you have to buy low and sell high. Not rocket science, right? So the problem is, when everything is going well for the stock, it poses a huge amount of growth rate, the earnings per share is crazy high, it wouldn't be low. So in order for you to really buy low and then sell high, there must be some sort of problems around the stock in the first place, or just the markets in general, like a black swan event. And subsequently, you have to be right in terms of trying to determine the underlying value of the stock so that it will recover and you have an exit opportunity. Simple, but not easy, isn't it? Now, back to Lazy Investor's comment. So he asserts that I have a good gambling instinct with sufficient risk management. Looking forward to my next big pun, investment. So I believe that there's no ill intentions behind the comment, but I thought it was pretty insightful. So let's break down what he said. So I don't know whether I have a good gambling instinct or not, but I'm pretty sure successful investors, or at least those that made a shit ton of money from the markets, have pretty good instincts when it comes to trying to understand the business and to look through many of these so-called smoke screens and BS around the company in the short term at least. And in order for you to be successful, you probably have to be contrarian in nature. So why contrarian, you might ask? Because stocks will only get low or get cheap when everyone is running away from them. Also, I would dare argue that being able to manage your emotions in a drawdown is far more important than having any sort of financial knowledge, whether is it a CFA or CPA or knowing how to do a DCF. This is ultimately still an emotional game. So on the point on whether I have sufficient risk management, I would argue that just by looking back at my 2 years journey thus far, so this was a really risky bet on my part. So I've recently came across this comment somewhere. I don't know where I've seen the comment, but it goes along these lines of, if you want to finish first, you have to first finish. So I think that really hit me pretty hard. I know that we all love a spectacular success story, someone that made a home run investment, maybe a 2x, a 5x, a 10x, or even a 100x of their initial capital, regardless of whether is it on instruments like Alibaba, Tesla, or even Dogecoin. Personally, looking back, I was really cocksure that Alibaba was bound to recover, whether is it in 1 year, 5 years, or 10 years. However, regardless of how confident I was, I shouldn't have disregarded my portfolio allocation rules in the first place. So despite me being so quote-unquote confident of my assessment of the particular investment, what if I was wrong? So even if it's a tail end risk of less than 1%, even if it was less than 1%, and the bears got it right, that China will nationalize Alibaba and shareholders will be eliminated in the process, I would have lost 60 to 70% of my portfolio instantly. Oh, and you have to take into account all my Chinese positions, assuming that China really pulls off something crazy, that would be about around 90% of my net worth. So in hindsight, I clearly was oblivious to portfolio management. Therefore, I do have a greater appreciation now, compared to then, on having at least 8 to 10 names that are preferably uncorrelated. So I'll reiterate the point here. If you want to finish first, you have to first finish. And you're probably finished if one of your bets goes south and you lose 60% of your initial capital. So my only defense for myself back then was that on an absolute basis, I still think that I'm not managing a huge ton of capital. Sure, it would sting to lose money, but since I'm still relatively young, I hope I can probably bounce back quicker. So assuming that you have a $50,000 portfolio, if you were to institute a very traditional and a very mainstream 5% rule, meaning that you can't have more than 2,500 in one particular company, you probably won't go anywhere with a $2,500 investment, even if you were to turn out to be correct. Unless you bet on some really speculative positions that might 10x or 100x in the next 5 or 10 years. So in retrospect, I'll still choose to concentrate moving forward, but with moderation of course. So a word of advice from a friend of mine. So if you're correct with your investment thesis, the position size will grow as the company continues to execute, just like Apple in Berkshire's portfolio. So Warren Buffett didn't initially place 40% of his portfolio on Apple. Apple just happened to grow and grow and grow until it became 40%. So let the companies prove their worth to you, and not you proving your worth to the markets by trying to allocate disproportionate amount of money for that one trick wonder. So on the second part of looking forward to my next big punt, don't worry, I currently still love this investing game. I don't see myself stopping anytime soon. So I'm always in search of the next investment opportunity or the next great idea, and my antennas will go up if someone claims that a particular company or a particular industry is uninvestable. So do look forward and stay subscribed to the channel. So I think here comes the distinction. When you're gambling, you're purely relying on luck and a streak so that you can leave when you're up. Investing, on the other hand, is a collision of many different factors involved. So it can be knowledge, it can be skill, it can be luck. But what really differentiates you from somebody that has a proven track record is the ability to constantly repeat the process. You can be lucky once, you can be lucky twice, 5 times, or even 10 times. But how long can you be lucky for? 10 years? 20 years? 40 years? I'm still relatively young, and as long as I don't stop updating, I think you guys can make the decision and be the judge on whether I was lucky, or I was skillful, or was it both. Similarly, you too can decide on whether I gambled my life savings on Chinese stocks or not. So with that, I'll see you in the next video, but more importantly, I will finally see you on the moon. Goodbye!